Hi everyone, it's Peter Schiff. It's Friday, March 5th, 2010. Well, all sorts of good news today on the U.S. economy. Earlier this morning, we got the good news that 36,000 more jobs were lost in the month of February. Now, I don't know why you would think this is good news, right? You would think good news was that we gained a bunch of jobs. After all, we've lost so many millions of jobs in this recession. You'd think that, we'd have some job growth, especially after all the government stimulus packages, all the bailouts. You think good news would be that people actually found jobs, as opposed to 36,000 more jobs being destroyed. But of course, when it comes to Wall Street, it's always the expectation game. The good news was that we didn't lose even more jobs. People were afraid that we might have lost 65,000 jobs or 100,000 jobs. And so the fact that we only lost 36,000 jobs is being hailed as good news. And in fact, whenever I listen to any of these reports on the day, on the news channels, it'll be good news today in the labor front, good news in the job reports. They don't even get into the fact that the jobs were lost. They simply put out the spin of the good news. I mean, if you heard the reports, you'd have thought we'd have created hundreds of thousands of jobs. But that's how it is with diminished expectations. Also, we got some more good news. Consumer credit rose for the first time in a year. I think it increased by about $5 billion, mainly because Americans took on more debt to buy cars. Again, this is supposed to be good news. We're going deeper into debt. We're borrowing more money to consume things, despite the fact that we're in a huge recession because we borrowed and spent too much money. It certainly isn't good news that we're borrowing more money. Good news would be that we're repairing our savings, that we're saving more money, that we're earning more money and not spending it. That would be good news. But no, Wall Street thinks the good news is that we went deeper into debt to buy more cars, and I'm sure a lot of the cars were imported, and so we simply ran up our trade deficit. Also, I thought one of the more interesting aspects of today was earlier in the morning, Barney Frank was given a speech, I guess, and I'm not really sure why he said it, but he mentioned the fact that people that are buying bonds guaranteed by Fannie Mae and Freddie Mac, that they don't have the same protection as people buying treasuries. Now, apparently this caused an immediate uproar in the mortgage market because, of course, the only reason anybody is buying Fannie and Freddie debt is because they assume that it's as good as treasuries. The government says that they've got it covered, and because nobody would buy these bonds without a government guarantee because they know that the collateral's not there. I mean, there's no way all these bonds are going to impose losses. Maybe their losses aren't 100%, but clearly the property is not worth anywhere near the value of the mortgages. So maybe the typical Fannie Mae bond is really worth 70 cents on the dollar, 60 cents on the dollar, 50 cents. I don't know. It's hard to say. But there's no way they're worth anywhere near par. So the only reason somebody would pay par for an asset that's obviously worth a substantial discount to par is because they know the government is there guaranteeing all the huge losses that are on the books of Freddie and Fannie. And so the minute Barney Frank questions the fact that they don't have that guarantee, of course, there's an uproar. So what happened is later in the day, the Treasury Department came out with a clarification to basically say, no, don't worry about it. We're committed. We're backing Fannie and Freddie in order to preserve the market for this debt. But what people need to be talking about is why are we doing this? I mean, why do we want to be in a situation where the government guarantees every mortgage in this country? I mean, would you want to guarantee your neighbor's mortgage? No, I don't know anybody that would want to guarantee their neighbor's mortgage. Most people don't even want to guarantee their kid's mortgage, let alone a total stranger. Yet that's what we're all being asked to do. Everybody in this country is guaranteeing everybody else's mortgage. Every time someone borrows money now, the U.S. taxpayer is co-signing the loan. Why would we want that? There are a lot of people that don't even own their own home. They're renting. Why are we forcing them to co-sign the loan as somebody who's buying? In many cases, buying a much nicer house than the apartment that they're renting. It makes no sense. Of course, the only reason we're doing this is to preserve artificially high home prices. Because you take that government guarantee away, and no one in their right mind is going to lend money based on this collateral. Nobody's going to lend money to somebody who can't pay it back. The only reason that you'll lend money to somebody who can't pay it back is because the government says, don't worry, we'll pay it back if they don't. But we don't want that. We don't want that moral hazard. We want a real estate market where individuals are able to convince banks to lend them money based on their own ability to repay, based on the down payment they make, based on their ability to prove their income and their assets, based on their credit history. We don't want loans based on the full faith and credit of the United States. That's how we got into this problem. But I think it's very interesting at that reaction. Also, of course, when we're focusing our attention on sovereign debt issues and how much debt other countries have relative to their GDP, it's not fair not to include the $6 trillion or so that Fannie and Freddie owe. Because after all, if we're telling our creditors these are as good as treasuries, then we ought to account for them as if they were treasuries. We should add that to the national debt, which we don't. Now, maybe you could say, well, there is some real estate backing them. Okay, fine. Let's take a 50% haircut then. So if Fannie and Freddie have $6 trillion worth of liabilities, let's add $3 trillion to the national debt, which means the national debt isn't $12 trillion, it's actually $15 trillion, which means it's more than 100% of our GDP right now. We have to be honest. We can't have it both ways. The government wants to have it both ways when it tells the creditors, hey, don't worry, buy these bonds, we're backing them, but they don't want to acknowledge that we're backing them when it tells the American people what the national debt is. Of course, there's absolutely no truth at all when it comes to governments. Anyway, the reaction in the markets to all the good news was that the stock market was up, but of course, it wasn't just stocks that were up. The commodities were up. Oil was up over $1 a barrel. In fact, this is a new closing high for quite some time. Oil is back over $81 a barrel. The dollar was a little mixed. I think it was relatively flat on the day, although some currencies like the Canadian or the Australian and New Zealand dollars had pretty big up days. In fact, even the pound bounced a little bit today. But the gold stocks were strong. They, even though gold was flat. So I think that you've really got the inflation trade coming back on. And as I said, I think in my last blog, I think the United States is going to be increasingly in the crosshairs of the bond market vigilantes who have been absent for a while, but who are showing their face in Greece and now in the UK. How can they avoid the United States? It seems it's impossible that we are going to completely escape their scrutiny, considering we are the biggest offenders, especially since we just went out of our way to alert people to the fact that all the Fannie and Freddie debt is, in fact, a Treasury debt. So I would expect to see more dollar weakness in the weeks and months ahead. I mean, the dollar index is still hanging out just above 80. It did manage to get as high as 81 and change at some of these peaks, but it's not, managing to gain any more momentum based on what it had. And if you look at the strength in other commodities, look at the strength in oil and precious metals, that certainly tells me that the dollar is more likely to go down than go up. Anyway, that's it for today. I'm off to some more campaign events. I have 2 places that I'm speaking this evening. I hope everybody has a great weekend, and I will be back again on this video blog next week. Take care.